The biggest investing mistake is not buying the wrong stock. It is letting your emotions decide for you. And unfortunately, the stock market out here is driven by two emotions: fear and greed. Most people make decisions based on fear or greed, and most of them end up regretting. The ones who end up standing by their decisions over time are the ones who don't let emotions drive their decisions. And that's why in this video, I want to talk to you about 10 ways you can be able to control your emotions so that you make very objective decisions while taking part in the stock market. In case you are new here, my name is Afagza Sifuna. I am a finance expert and qualified accountant, giving you these amazing videos about making money and investing each and every day. If you love this kind of topics, down there is a button called subscribe. Consider subscribing for you not to miss any of my uploads. And while you're still at it, drop a like on this video. Thank you for subscribing and also liking this video. Having said that, the first emotion which typically drives the market is something called FOMO, fear of missing out. Case in point, if everyone is talking about a given stock, ask yourself, have you done your own research before you jump on that stock too? Because yes, everybody could be talking about a given stock, right? But what if most of those people, or even all of them, haven't done any analysis? Or even it might be a campaign to pump up a given price of a given stock. You not doing your own research is going to cost you. That is why you need to identify fear of missing out. When everybody's talking about something, don't feel like you need to partake in it if you are not ready. Seasoned investors utilize their own research and they are patient when they are making a decision in the market, not jumping because of fear of missing out. Okay? And then the second thing, don't panic when stock prices fall. A number of investors out there do panic. Case in point, maybe stock of company X, or let me just use a Kenyan example. Maybe stock of Housing Finance Group is on the decline. A good chunk of investors might start panicking and selling their stock. That is a wrong move. And I'm saying so because, first and foremost, history has already proven in any broad market dip, the prices do recover, okay? Because it is a macro kind of like dynamic. And even for individual stocks, prices ultimately do recover. Because when you look at any company which was listed many years ago, you're going to realize their aggregate return over the years is way in the positive. I'll give you an example. Equity Bank stock, okay? Of course, there are those moments where Equity Bank stock has gone down, has come up, has gone down. But in aggregate, since Equity Bank was listed starting in 2006, right? It began at 2006, its share price was about 3 shillings and 60 cents. Right now, its share price is inching 80 shillings. Basically, it has increased by upwards of 1450%. If you invest, for example, 100K in 1996, right now, you'd be sitting with pretty 1.4 million Kenya shillings in your equity stocks. Of course, in between there's moments of dipping and price increasing, but don't let a short-term fear or price movement in the market dictate your long-term decision. And then the third thing you need to know now is the opposite of fear. Also, you need to control your greed when stock prices are on the rise. A good chunk of investors out there, when they see stock price on the rise, they might assume it's going to continue rising to perpetuity. They might end up pumping lots of their money there, okay? Buying and buying and buying and buying. What if it was a short term, okay? And the price is going to drop or even dip beyond the level it was before you did the purchase. So, the same way you are trying to control fear, don't let greed kick in and make you go long on stocks which you shouldn't be going long on. Of course, most seasoned investors out there, yes, they do buy the dip. That is amazing. But they only do that after doing their own research. At the center of all these things is research. Emotions kick in when you are jumping on things without really understanding what you're doing. Case in point, when you talk about greed, yes, it is good to buy the dip, but then again, have you researched to know what is going on? all the different aspects, technical and fundamental, before you jump on it, because jumping on it could have repercussions. And even out here, I've seen, for example, someone go all in with their savings on buying a given stock because it was on the rise, only to realize that stock did crash and they ended up losing a good chunk of their money. So be keen. The same way you are keen on fear, also be keen and cognizant of greed. So as not to make a decision based on greed. And then the fourth thing, you need to know that when you are partaking in the stock market, it is okay to know that sometimes you're going to be wrong. Even the season of investors out there, people who have done top-notch trading, they are wrong from time to time. And that is why you need to also be keen and admit to yourself if you are wrong, because that is going to be the starting point of you reversing any position. Case in point, if fundamentals are telling you a given stock is not performing okay, it is bad, the company and things are bad, is on the decline. Maybe even the company is having irrecoverable legal issues, okay? The company is having management challenges. You are seeing all the signs. Fundamentals are telling you that. In the stock market, price around the decrease is telling you that. Why are you insisting on holding on that particular stock? You are insisting on holding because you are also denying that you might be wrong. And there's nothing wrong on being on the wrong. The most important thing when you are investing is you protecting your capital, and hopefully you are able to make a gain, whether through share appreciation or even dividends. So don't hesitate to admit you are wrong and take corrective action, because no one has the blueprint on how to beat the market out here. And then the fifth thing you need to be cognizant of, don't be overconfident after a few wins. It is in the human nature. After a few wins, you might start feeling like you know what you are doing, okay? You might start feeling like you have the blueprint of success. Unfortunately, that is not the case. Being confident while trading is amazing. Being confident while in the stock market is amazing. But overconfidence is the starting point of you making very big mistakes. Because overconfidence is going to make you maybe even take up on bigger lots, okay? It's going to make you end up reacting more emotionally as opposed to sticking to your plan. Don't be overconfident, just have a strategy and stick to it. If you win, fair enough. If you lose, it is lessons which you continue refining as you continue refining your trading or your investing strategy. And then the sixth thing you need to be cognizant of and avoid by all means, avoid watching the price or looking at the price of shares or stocks. Guys, this is the starting point of you triggering emotional reaction. Case in point, you are sitting there glaring at the markets. You see a stock you've invested in your portfolio is going down and down and down. Any sane human being out there will fear and maybe even decide to go short, okay? And if you're sitting there, for example, and you are seeing the share which you invested in is increasing in price, you sitting there watching the charts might make you decide to buy more and more. And you're going to be doing this just looking at the market signals without doing any fundamental analysis, which is basically you reacting in an emotional way. That is why you need to have a cadence of you doing comprehensive review of your portfolio as opposed to sitting there watching how prices are moving in the market. Avoid doing that. If you want to do well for yourself and also for investment to be okay, have a standing cadence. Even it could be like you are looking at the stock prices once a week. It doesn't hurt because you have already invested in that particular stock and you have a plan or strategy as to why you invested and what you're looking for. That way, you really work without having emotions dictate what you are doing. And then related to that, the seventh thing you need to know is that you need to have rules laid down very well before you start investing. Case in point, what is your goal of investing? What is your strategy? How frequently are you going to be reviewing your portfolio? Okay? And based on portfolio dynamics, what corrective action are you going to be doing? All this need to be defined very well in the app right when you are starting before you invest. And I'm saying so because if you don't define what you are looking for, what the strategy is going to be, okay? What the rules are going to be, that is a starting point of you even investing emotionally and continuing to make decisions emotionally, which at the end of it is going to cost you. Out here, seasoned investors, even though people out there think they're just making money, they typically have a strategy, which they have documented. They really heed to that, and over time, they refine their approach. So you to define the rules upfront before you jump into investing. And then the eighth thing you need to be cognizant of is that you as an investor all the time focus on the business. And I'm saying that because you sitting there, for example, looking at the charts full time, you are looking at the wrong things. Because you're buying a given share or stock, you are basically becoming part owner of a company. And what needs to be driving your decision making is the company health. Is that company doing well with regards to revenues, right? Is that company having and continue to solidify its market share or competitive advantage? Is the management acting in the best interest of shareholders? Those are the things you need to be focusing on, because if a company performs well, ultimately, the sentiments from investors are going to be positive and the share prices are going to increase. So understand that you have invested in a business. So focus on the business as opposed to just sitting there looking at the charts, because that's just a ticker symbol, which in reality, by itself, it doesn't really mean much, because it's going to just be the starting point of you reacting emotionally as opposed to having your emotions in check based on fundamentals. And then the ninth tip for you is that be patient. And that is not something new. History has already proven wealth is built through patience, discipline, and those who avoid emotions while taking part in the stock market. And that is why you need to be patient. You can't buy a share today and you are looking at the chart the entire week, hoping you're going to sell it next week and make a profit. That is not how it works. Compounding only works well in a time horizon. Basically, you being patient, compounding is going to kick in, and then it's going to allow you to be able to make money due to your patience. That is how wealth is built in the stock market. Exercise patience and good judgment, and you're just going to be okay at the end of it. And then the last tip for you is that you need to be very intentional about building habits that are going to keep emotions away. Emotions can't just be kept away because you're saying emotions stay away. You need to build habits which actually ensure you are confident in what you're doing, so that you believe what you're doing is right and you stick to it instead of using emotions to decide your next course in the stock market. And the three habits you need to build are, first and foremost, you need to keep learning. Okay? Continue learning for you to understand how the stock market works, how the companies you have invested in actually do business, how do they make a profit. You having that knowledge and continuing to refine the knowledge over time is going to put you at a good place. And then the second thing is that you need to diversify. Diversify your portfolio so that you just don't sit there looking at one stock. Even have 20 stocks. If one is doing badly, chances are the remainder are going to be doing okay, and you won't really feel any form of greed or even any form of fear. And then the last tip for you when it comes to managing your emotions is use simple techniques, like for example, dollar cost averaging, to be investing regularly instead of investing at once and then monitoring your money, thinking it needs to be growing rapidly overnight. That is not how the stock market works. Even have a cadence of investing fixed amount of money every month, regardless how the share is doing or how the stock is doing, because either way, over time, you're going to have a good return on your investment. Guys, what do you think about this video? Have you been a culprit of letting your emotions dictate how you behave in the stock market? Comment down below. Let's continue discussing. But I hope you've gotten a tip or two which you can utilize for you to be able to ensure you have your emotions under check as you are taking part or looking to build wealth through the stock market. Cheers, guys, and catch up in the next video.